Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And the market has continued on the path that we spoke about here last week with respect to continuing to melt higher, if you will. But some of the concerns that we saw here last week in terms of exhaustion, in terms of divergence, actually have gotten worse. So we want to talk a little bit about what those indicators are and what that means for your outlook going forward. Before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So what we'll do is we'll first start off by taking a look at those major equity indices that I was referring to, which ones are showing some strength in confirming these new highs and which ones are not, and most of them are not. And those are some of the concerns that we currently see. Then we'll take a look at the fixed income markets. Largely, we have not seen any movement from the fixed income markets. Pretty much in equilibrium right there, probably still in this debate of whether inflationary concerns are more transitory or permanent. So far, neither side is winning. So we'll take a look at some of the economic indicators for that. But before we do, we'll take a look at the sector rotation model, which is something that we look at to get a better sense for the health of the market rally. Seemingly, there is the start of some rotation, but I do want to do a bit of a deeper dive into some of the major sectors that are starting to see rotation and take a look at whether we see whether or not we believe that rotation is going to continue. Then we'll take a look at the economic indicators we're referring to before sharing some of our ideas for today. But the primary question that we really want to answer from investors is the current breakout here in equities an opportunity? And when we look at the broader markets, this is really where, when we start at the S&P 500, we are starting to continue to make higher highs in price, as we showed you here last week. But we continue to see where higher highs in price are no longer confirmed by higher highs in momentum. Now, this in itself is not a reason to short the markets. This is simply just a warning signal that going long in the current market conditions right now, statistically speaking, is not a great strategy. That waiting for pullbacks here is a better opportunity to look for long positions, and there's a higher probability of a pullback when you see this type of negative divergence. Now, the divergence itself in itself is not major. We don't see a huge amount of divergence, which doesn't lead us to believe that there's going to be a major sell-off here. And then when we look at the NASDAQ 100 index, this is where the technology index continues to make higher highs. Now, last week we talked about the higher highs in price continues to be not confirmed by higher highs in momentum, but this week we started to have some of that confirmation. So for many, many months, we've been talking about this negative divergence in the NASDAQ 100. But just last week, we started to confirm the new high with momentum. So this leads us to believe that this technology rally here has the legs to continue moving higher. It's the only market indice or only major market indice where we have seen higher highs in price being confirmed right now by higher highs in momentum. So this gives us better confidence in the NASDAQ 100 rally rather than any of the other major indices. If you look at the Russell 2000, still in this range-bound mode, failing to break out from this 230 high on the Russell 2000. Now, it is printing lower highs, so it does have the potential of the breakout here, but we're not seeing the breakout just yet. And this is something that we're seeing across all of the major indices, including the equal weight, which is fairly concerning to see the market cap S&P 500 index make new highs, but the equal weight index actually making lower highs. This is just giving us evidence that the broad number of stocks in the S&P 500 is not participating in this rally. It's just the few major market cap stocks, Facebook, Apple, Amazon, Google, those are the stocks that are continuing to rally while the rest of the stocks are being left behind. That is not a particularly great setup for markets to continue moving higher. These are some of the things that we've been talking about here over the past few weeks. These things have only continued, or if not have gotten a little bit worse. And for those of you that are followers of Dow theory, as the S&P 500 made a new high, Dow Jones Industrial Index making a lower high. That divergence is not particularly strong. And you also have the Transportation Index making a new lower high. These have not made new lower lows, so it's not a reason to go out there shorting the markets or believing that markets are going to start to decline. But this is more of a corrective pattern within a larger bullish trend that we're currently seeing. So when you see this type of negative divergence across most of the major indices, this is just warning signals that we are near potentially a market top, but that doesn't necessarily mean that this is the right timing for a market top. This just means that we are continuing to trade towards a market top here right now. And especially when you look at the number of stocks participating on this rally, only 54% of all stocks are trading above its 50-day moving average. Those are not the numbers that you typically see when markets are breaking to new all-time highs. Look at the rally from November through January. The number of stocks trading with above its 50-day moving average stayed above 72% or so. Right now, we're trading at 54%. That just shows you relatively how weak the overall market is compared to the November breakout that we saw after the election. So those are some of the warning signals that we're starting to see here from equities. But if you look at interest rates, they remain range bound here between 145, 155 basis points, still in this debate, if you will, as to whether inflation is transitory or permanent. Transitory, believing that perhaps interest rates overshot it a little bit and is now coming back down. Those that are debating it's more permanent see opportunities for interest rates to rally significantly higher from here. So this is going to have a fairly significant impact on the equities that you own in your portfolio. So this is one that's worth paying attention to as this debate continues to unfold. And sometimes, you could sit there and look at all the economic indicators and try to get a sense for whether inflation is more transitory or permanent. But you could also just look at the interest rates. The interest rates will effectively tell you what the market is pricing in. So right now, markets are indecisive. Look at interest rates, keep an eye out on. If you see a breakout one way or another, that's going to mean that one way or another, the market is, one side is winning the debate versus the other. So when we look at sector rotation, like I said, over the past 3 to 4 weeks, we have seen a fairly lack of rotation here, meaning strong sectors remain strong, weak sectors remain weak, but we started to see a little bit of rotation here this week. Not enough to change the relative strength rankings. As you can see, pretty much every stock that was weak last week is still weak. Every sector that was leading is still leading. Every weakening sector is largely still weakening, with the exception of healthcare that has turned healthcare and discretionary that is now leading, and utilities that is now weakening. But as you can see, there's what looks like the start of some rotation here. Financials, industrials, consumer staples, materials moving higher, technology, discretionary, potentially healthcare moving lower, communications moving a little lower, real estate moving a little lower, and energy moving a little lower here. So not a whole lot of rotation, but certainly what looks like the start of some rotation here. And this could be this, when we talk about these equity indices that are starting to show divergence, the divergence itself, like I said, is not a reason to short the markets, because the divergence could resolve itself by all of those indices, the Russell 2000, the Dow Jones Transportation, and the industrials, the RSP, the equal weight index. All of those indices could start rallying and confirm these new highs, and for equities to continue its move higher here. And sector rotation can start moving in the right direction, and we all have the creation, if you will, of a fairly healthy market rally. But when we dive into the individual sectors themselves, this is really where the evidence is not quite as strong as some of the sector rotation model might show us. So looking at communications, which is one of the sectors, as you can see, is starting to weaken, right? And if we're starting to see these strong sectors weaken and these weak sectors strengthen, then that is a good sign that that sector rotation is happening, and and the market rally is perhaps becoming a little bit more healthy. But when we look at communications, we continue to make a new all-time high on an absolute basis. And then when we look at communications relative to the market, this is XLC relative to SPY, we continue to see communications actually break out relative to the broader markets. So this is showing me that some of the strong sectors are likely going to remain strong because they continue to outperform the broader markets. And then when you look at some of the weaker sectors that are starting to outperform, like industrials, despite the strength we've seen here over the past 5 days or so, looking like it could continue moving higher back into this 107 range and retest that triple top and potentially break out even further and gaining relative strength here. But when we look at industrials relative to the market, we're not quite seeing that evidence. We've recently broke below some support levels. It came back to retest that level of support. So relative to the market, industrials, despite seeing the small rally here over the past week or so, is actually continuing to lose ground relative to the market. This leads me to believe that the small rotation we've seen into industrials here, these types of rotation here, is not likely going to continue and move into the leading category, is more likely going to just simply fail and continue to stay in the lagging or perhaps weakening category. So those are some of the concerns that I see when you dive deeper. And then you look at technology, the sector that looks like it's starting to weaken or lose some of that momentum here. As you can see, breaking to new all-time highs on an absolute basis and on a relative basis to the market continues to make new highs. And recently, technology has underperformed pretty much since March. But as you can see, recently breaking out from that bearish trend line, indicating that technology could continue to outperform the broader markets. So these strong sectors that we're hoping would weaken and seeing the weaker sectors strengthening, we're not quite seeing that. I don't see the evidence that holds up that these weakening sectors are going to all of a sudden see some strength, because relative to the market, they're actually continuing to weaken. And lastly, real estate, one of the sectors that continues to be extremely strong, as you can see, testing the 21-day moving average and this bullish trend line, looking like it can continue moving higher. Also relative to the market, as you can see, real estate extremely strong and actually recently breaking out from this trend line higher relative to the market, coming back to retest it, and now has the potential of continuing that outperformance relative to the market. So this is really, when I look at the sector rotation model, I'm not quite convinced that we're seeing that we're starting to see some healthy rotation that's going to resolve these negative divergences that we're seeing. So from my perspective, if you look at everything on balance, there's no doubt that the equity markets are pointing in a bullish direction, but the direction that we're pointing in is not particularly healthy. But I will say, one of the things that we continue to tell investors is that these unhealthy market conditions, they don't resolve themselves fairly quickly. Sometimes they can go on for months before they resolve themselves. We saw it last almost 4 months before the coronavirus sell-off. From about November of 2019 to about mid-February of 2020, markets continued in a very similar fashion to what we're seeing today, which is lack of rotation, major market cap stocks moving higher, but the broad number of stocks not advancing any more than that. So seeing market breadth narrow, lack of sector rotation, and these negative divergences. But that lasted 4 months. That wasn't something that lasted for 3-4 weeks. We see it and we start shorting the markets. These things can last for a long period of time. So be careful. Don't use this evidence as a reason to go out there short these markets. But they are things that you should think about in terms of, do you establish new positions in the current market rally, or do you use them more as profit-taking opportunities for some of the stocks that you have some significant gains on? That's how I think you need to think about this current market condition. And then looking at some of the underlying data from a from a economics perspective, this goes back to the debate as to whether the inflation we see is transitory or permanent. I feel like a broken clock continuing to talk about this, but this is really where most of the market is focusing their attention on from an economic data perspective. The labor data, which is a big part of inflationary concerns, we're starting to see some things tick in the right direction, I would say. You have quite a few states where unemployment benefits ended on June 19th, and we're starting to see initial claims fall substantially in those particular states. And the question is, are those unemployment claims just simply dropping off, but are those people returning back to work? When you look at the search results for the states where their unemployment has dropped off either June 12th, June 19th, or this week, or rather last week, we see a significant jump in terms of searches for part-time jobs versus the states where unemployment benefits have not expired or don't expect to expire until July or so. So when you see people searching for jobs in the states where unemployment is expiring, this fits the narrative that the Fed has, which is the fact that as unemployment benefits expire, they expect more people to rejoin the workforce. That's going to ease some of the wage inflation that we're starting to see. This fits that narrative that inflation is more transitory. As you can see, from an interest rates perspective, the markets are kind of still unsure of that debate. And then when you look at the manufacturing data, this is the other side of the equation. Raw materials, consumer goods, the cost of things that you need to buy in the store. What does that cost and how is that changing in terms of price? This is really where we're still not seeing kind of an easing, if you will. We're starting to see a little bit of easing on the wage side or the employment side, but the consumer goods, the supply chain issues, these are actually continuing to accelerate and actually worsening. So you have kind of these two dynamics at play. And the markets, like I said, when you look at the interest rates, I think interest rates is a good barometer of which side is winning this equation. The answer is pretty, I would say, balanced at the moment, because potential gains that you have in employment is being currently offset by the other side of the equation. So when you look at manufacturing wages and benefits continuing to accelerate to the upside, not just staying elevated, but accelerating, and the number of unfilled orders. So this is caused by supply chain constraints, labor constraints, raw material shortages. That continues to remain elevated. And when we look at things like shipping container rates, when we look at port, the number of containers that can be unloaded at a port, these types of high frequency data continues to actually worsen, and there isn't any signs that they're easing at the moment. And at the moment, it seems like it's going to get even worse towards the end of the year, especially as we get towards the season where retailers and manufacturers are starting to stock up for the holiday season. So this is causing more disruptions across the board. And this is some of the underlying data that we're paying attention to right now. But like I said, even if you're not the type of person who wants to sit there looking at economic data every single day and tracking these things, one good way to just to get an idea of the big picture is to look at that 10-year rate. Look at the range bound motion that it's currently in between 145 and 155. If you start to see interest rates break out one way or another, that gives you a sense for one side of the market, if you will, winning the debate. So looking at opportunities here, like I said, overall, there's no doubt markets are in a bullish trend. There are concerns that I see in the markets. There are warning signals, but that in itself, not a good reason to go out there and short the markets. You might find some interesting short opportunities within specific names, within specific sectors, but overall, I still prefer looking for more bullish opportunities here in this market, especially ones that are oversold, comparable to its revenue growth, comparable to the fundamental picture here. And one specific one that continues to jump out at me that has looked like it's been an opportunity, but has now gotten quite extreme, are the airlines. Specifically, the domestic focused leisure focused airlines like Southwest Airlines that have strong balance sheets and also have hedged fuel costs, because not many airlines these days hedge their fuel costs. And with crude continuing to rally here, that's part of what's causing the weakness that we're starting to see with airlines. But Southwest Airlines is fairly unique from the perspective of they're one of the few ones that do hedge fuel costs. They are almost entirely exposed to domestic leisure travel, which we know is one of the strongest rebounds we've seen in commercial aviation. If any of you have been on a plane recently, you know that some of them are, most of them actually are quite full, and many airlines right now cannot even keep up with demand. American Airlines have canceled a bunch of flights because they don't have enough pilots to fly them. Southwest Airlines really, I would say, navigated the pandemic fairly well, and were one of the airlines that really expected a faster rebound than some of the other ones. So the fact that the Southwest Airlines is trading substantially lower than where it was a month ago, this is really the opportunity that I see for a bounce. It's now trading back towards its 200-week moving average. It's now significantly below the 200-day, the 21-day moving average. And statistically speaking, I'm looking for a potential bounce on a stock that looks financially healthy and well positioned here for the broader rebound. And as you can see here on the RSI, recently on the daily, oversold here. That is the opportunity that I see. A very similar type play here is DR Horton. Looking at the home builders, we saw a substantial slowdown here in the home builders here over the past month or so after peaking around 104 or so on DR Horton. But we know housing markets remain extremely resilient and extremely strong despite a pullback and a deceleration here of the past couple of weeks. And we know inventory levels are still declining and at all-time multi-decade lows. That is an environment that's supportive for home builders. And this is really where the pullback we've seen here in DR Horton back to the 21-week moving average, the 200-day moving average, in my opinion, are opportunities to look for a bounce higher here, especially since the price here has seemingly found a bit of a support level after breaking out from the weekly chart, pulling back, looking for that opportunity. And then lastly, when we look at technology, it's hard to ignore the strength that we've seen in technology. And the question again becomes, where within the technology scope do you want to be? Quality versus growth. And this is really where in the current market conditions, because of the increasing divergence that we see, the lack of sector rotation that we see, my preference is to be towards quality rather than those high growth, non-profitable stocks. Now, it's very hard, in my opinion, to pick stocks that are oversold or in some way, statistically speaking, have a better chance of moving higher here, because as you can see in any trend, whenever you have a bullish trend, you want to wait for a pullback. You want to wait for things are oversold, because that's when you have the highest probability of that bounce higher here. And right now, the statistical advantage that you have on these stocks is not to your advantage, because they're trading near overbought conditions, that your preference is to wait for a bit of a pullback here before you look for that opportunity. I'm not sure how much of an opportunity you're going to get on some of these pullbacks here. So this is one that I think is worth paying attention to, but I wouldn't necessarily create a full position here. But looking at quality companies like Microsoft, Apple, highly profitable, high growth, Amazon Web Services, these are the types of names that I would pay attention to, establish some long positions, but maybe only a quarter or maybe a third of a position now. See if you see some weakness here over the next few weeks or so and look to add to that position. But in the meantime, if these continue to move higher, you at least have some exposure to tech continuing to outperform, which we clearly see is one of the only indices right now that have confirmed new higher highs. So with that, that covers what I wanted to share with you here today. Like I said, on balance, things still look fairly strong, but warning signals are starting to increase here. Be aware of these things. Be aware of that sector rotation that seemingly is there, but may not, stick around, if you will. And if we continue to see technology, discretionary communications dominate, while industrials, materials, utilities continues to weaken and actually underperform, or actually most of the major sectors underperform with just technology really dragging the markets higher here, that's going to be concerning the longer that goes on for. So be careful and be mindful of that as you look for opportunities here in the broader markets. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here on Tuesday of next week.